Corporate Finance Presentation, Fixed Asset Replacement Decision. Get ready, it's time to take your chance with Corporate Finance. Fixed Asset Replacement Decision. This decision is going to be similar to some of the capital budgeting decisions we've had in the past, where we have the typical scenario of putting money down up front for things like equipment or an investment or a project in order to generate future cash flows. When we're thinking about replacement of a fixed asset, so we have a large fixed asset, for example, that's already on the books, possibly something that we're using, we think that a new fixed asset to replace it could improve production in some type of way. Should we then replace the fixed asset or keep the old one? Has similar characteristics as a typical kind of budgeting, capital budgeting type of decision, but is more complicated due to having the two factors involved with the decision: the old equipment to keep it or to sell it off. What kind of income might we get if we were to sell it? And then the new equipment we're gonna put on the books. And then we have to take a look at the tax consequences, which does include the factoring in of depreciation. And it gets a little bit more complicated due to the fact that we got to now consider the depreciation that would happen if we had the old equipment versus the new equipment. So note, this decision-making process is typical to like a normal decision process for an individual, for example, to replace the car or not. However, with an individual, you might have other things that you're putting into place, like the level of enjoyment you're going to get from the new car versus the old car, as opposed to just performance, most likely. In the business decision, obviously, we're geared towards revenue generation, so we can kind of narrow down the goal here for revenue generation as to whether or not we should get the new equipment or stick with the old equipment that we have on the books. Now, this type of decision-making process is best seen in a practice problem. We want to point it out here, and then when you go through the practice problems, make sure you go towards this kind of problem just to get a feel for how it will differ from a normal capital budgeting decision. So additional factors over the basic investment decision. Remember, the basic investment decision being that you're going to be putting money down up front. We're having an imagine for possibly equipment type of situation, but without a replacement situation. If it was just a capital budgeting new piece of equipment, then we'd have to think about the initial outlay that would go out up front and the savings or cash flows that would be involved in the future from it, and typically then be using our present value calculations, including net present value and internal rate of return. Now, if we have the old piece of equipment and are deciding to replace it or not, we have added conditions that will be taken into consideration, including the sale of the old fixed asset. So in other words, if we choose to go with the new fixed asset, then we may want to sell the old fixed asset, and we might get money for that. So the cash inflow that we would get would have to be taken into consideration with regards to the tax consequences here, over and above the factors that would be in a normal kind of capital budgeting decision. Tax consequences of the sale. So when we make the sale of the old equipment, are there any tax consequences? Because the tax consequences are cash flow type of things, and they complicate things, of course. Taxes always complicate things a lot. So we have to take into consideration the tax consequences and the cash flow related to them. You can analyze the decision using either the total analysis of both fixed assets, the old and new, or using an incremental analysis of cash flow changes between the fixed asset options. The second one is often what we're going to do. In other words, if you're trying to think about two different roads you could take, you can calculate the entire outcome of road number one and then the entire outcome of road number two and compare the two. Or we can take a look at the differences. What are the factors that will be different if we were to choose option one or option two, because those differences are the relevant factors in a decision-making process amongst the two. And then we can basically use that differential kind of analysis to make the decision. So sale of the old fixed asset. So this is kind of the process. The sale of the old fixed assets, cash flow from the sale based on market price. So if we're trying to decide whether or not we should sell it, we'd have to figure out what we can sell the equipment for. This is not an easy question all the time, because the old piece of equipment is an old piece of equipment, probably still valuable, but it's unique oftentimes in nature, because it's, a piece of equipment that we've had for a while. If it was a car, you'd have to get the blue book value and whatnot. You have to determine how much you might be able to sell the old piece of equipment for on a cash flow basis. And then you want to take a look at the tax impact, which would include the calculation of the book value for taxes and compared to the sales price. So in other words, if we were to sell the old piece of equipment, it has been depreciated over time. The old piece of equipment we put on the books. Now, even if we paid cash for it when we purchased the old piece of equipment, for taxes, typically you have the accrual concept on the tax code of putting the old piece of equipment on the books and allocating the cost over the useful life of the old piece of equipment, usually using a maker's type of depreciation, which is a type of accelerated double declining balance with a half-year convention. We'll go over that in the practice problems more. And there could be added depreciation like bonus depreciation and 179 depreciation and whatnot, which means you could end up front-loading the depreciation, which means that if you have more depreciation at the beginning, that's going to mean that you utilize the expense of it up front, and that could result in basically when you sell it having a gain, right? So the depreciation being higher in the beginning years is often what the government will do to try to stimulate the economy, to get people to buy more equipment and do more business and whatnot. And that's good because we get the deduction earlier. But then when we sell the equipment, it might be that we over-depreciated it because we got the accelerated depreciation. And that means we might sell it for a gain at that point. And if you have a gain for taxes, note that that's bad for taxes because the gain represents kind of income, and income would have to be something that would be taxable. So we'd have to figure this kind of book value. When I say book value, I mean the asset, the fixed asset minus the accumulated depreciation. That's what we often call the book value, not to be confused with the book value on the books, because the depreciation for taxes will be different than what we could also sometimes call the books, or the accounting books, right, which are different, which might be on an accounting standard such as generally accepted accounting principle, and then have different depreciation schedules. We're concerned here with the tax depreciation schedules because that's the one that's going to have the tax impact, which is the cash-related impact. And we're looking at cash flows here for these types of decision processes typically, so we can apply our present value type of calculations. Therefore, when we're looking at the book value, that means it's going to be the asset minus the accumulated depreciation, but on a tax basis is what we're looking at. So then we want to estimate the tax impact of the gain or loss. So once we have the gain or loss, if it was a gain, then have a negative kind of tax impact on that, because a gain would be like income for taxes. So that would make us possibly owe taxes, which would be a cash flow type of situation. So in other words, we would have got the cash inflow from the sales price, and then we'd had to calculate the book value to figure out the gain or loss. And if it was a gain, then we'd have a tax impact on it owing taxes, which would be like netting out or an outflow. And if it was a loss, then once again, we got the cash inflow from whatever we sold it for, and then we had to figure out the book value. And if we had a loss, we typically would have a tax benefit from the loss. So that's going to be a quick overview of this type of scenario, or the differences in it. Obviously, the practice problems are the best things to take a look at. We do them in both presentation, in like a OneNote calculation, and in Excel. So if you're going through the practice problems, there's a lot of them. Make sure that you're picking one up that is of this nature so that you get a feel for that.